and welcome to the ETF.com Economic Outlook for 2025. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. We've got a great panel here to talk about where we are headed in 2025 and where we were in 2024. We'll be taking your questions throughout, so don't be shy about that. And also, we'll be wrapping up with some predictions from our panelists. So you'll want to stick around to the end. Joining me on the panel, Christy Akulian, BlackRock's head of iShares Investment Strategy, Jay Woods, Chief Global Strategist at Freedom Capital Markets, and Nick Kalivas, head of Factor and Core Equity Product Strategy at Invesco. I want to welcome each of you, and I'm going to go around and have each of you do your own little introduction so people can appreciate why you're perfect for this panel. Christy, you want to start us off, please?
Sure, I'd be happy to. First, thank you for having me. So I'm Christy Akulian, as just mentioned. I'm the head of investment strategy for iShares at BlackRock. I've been at BlackRock for almost 15 years. It'll be 15 years in a few months. And the majority of my career has been spent in the ETF world. So focusing on ETFs, everything from capital markets, product and investment strategies. So love this conversation and excited to talk about 2025.
Okay, great. Jay, how you doing?
I'm doing well. Thanks for having me, Jeff. My name is Jay Woods. I'm with Freedom Capital Markets. I'm their chief global strategist. Before Freedom, I spent 28 glorious years trading on the floor of the New York Stock Exchange, but I pivoted to talking about the markets. And one of the biggest changes I've seen in my career are how ETFs are influencing those markets. And when I study markets, I do from a top-down approach, and I always break down major ETFs and look what's under the hood. So this conversation is going to be fun, and I'm appreciative to be here.
Okay, thanks. And Nick, hi.
Hi, great. Thanks for having me. Nick Kalivas, I'm head of Factor and Core Product Strategy for the ETF and Index Strategies area here at Invesco. I have been here since about 2013. I cover about 95 ETFs with AUM that's north of 500 billion. And really kind of act as the expert on these ETFs. I'll say that humbly, but we answer questions of like, what is this ETF? Why should I own it? How does it work? When does it work? And really help with kind of thought leadership and positioning of ETFs, kind of being an advisor to advisor in terms of how to utilize ETFs in their portfolio.
Okay, great. Thank you. All right, let's get rolling into this here. As we sit right here on December 10th, by my latest calculations, this about an hour ago, the S&P 500 is up 29% this year. Gold is up 27% this year. The Magnificent Seven, those hard charging collection of stocks, is up 65%. Bitcoin's up 120%. Obviously, I'm just cherry picking here for the sake of a good conversation. But let's start with you, Nick. What are some of the economic and market issues that stood out in 2024? Kind of getting us to where we are now.
Yeah, sure. So really, 2024 has been a tale of two markets. I think kind of through early July, it was a market that had very concentrated earnings that was driven by secular trends like AI, GPL1. And really, if you look at the market, it was big, growthy, momentum driven, and quality driven as investors essentially tried to navigate where the earnings were or kind of play a little bit of defense as the general market was starved for profit growth. And then about July, things shifted gears a bit and we saw smaller stocks, value stocks start to do better. Momentum has stayed pretty strong, but really the change there was the market kind of rethinking or not straightlining AI as much anymore, GPL1, thinking about the Fed cutting rates, starting to believe a little bit more in the convergence of earnings per share between the smaller stocks or the broader market and kind of those big names that were driving. And that's really where we stand today because the election seemed to kind of reinforce what happened kind of starting in July.
Okay. Christy, what's your take?
Yeah, and I agree with most of that. I think it's interesting to note that if we were having this conversation a year ago and talking about what to expect in 2024, let's not forget that, the market expected as much as 7 Fed cuts, right? And that the interest rates were going to come down precipitously. I think most economists and observers were talking about whether we were going to be in a recession in the first or the second half of the year. And so I think a big part of the story is Fed cuts being priced out of the market, but coming out for good reasons. Growth surprise to the upside. And we did start to see, kind of that earnings renaissance that Nick was talking about too, of we've seen power and strength from some of the top of the market, but over the course of the year, we saw that broaden out as well. So I think those are really important things to keep in mind. A lot of this is driven by just strong economic growth, stronger than we expected for this year. And then really, I think where the market did best really came down to where earnings growth was the strongest. And I think that sets us up for a really interesting 2025 because that story is evolving right now as well.
Yeah, interesting 2025. Good segue here. Jay, I'm going to let you take the segue here. Same question. What, the factors that got us to this point and how are they likely to impact 2025? I know it's just we do this all the time. I know it's just a day on a calendar, but it's still a 12-month period we're going to be looking into.
Yeah, and that's when we get judged by the first day of the new year, and we start all over. Not us, but those that judge us do. And what I look for right now is a continued theme. My theme of 2024 was rotation. 2023, 7 stocks did the heavy lifting. 2024, we got rotation. And when one sector was beaten down, other sectors led. Just last week, the 3 big sectors were the big sectors from 2023 in discretionary technology and communications, and every other sector was down. Money's not leaving the market, but it rotates. And to me, rotation's the lifeblood of a bull market, which sets us up for a continued theme going into 2025. Very similar, and we make the comparisons a lot, 95, 96, 97, 98, going into 99. This is a secular bull market. There are very similar things behind the scenes. A Fed that's easing rates, and a new technology. This time it's AI and what powers AI. And I think that will be a theme. And I look for those things that power the AI story to be in play. And then people are going to be selective. It's going to be an interesting thing to see who's been putting all that CapEx spending to work and then using that to get results. We saw it with Salesforce individually last week, and we're seeing the software sector ETF, the IGV, start to take off. What AI stories will actually play out and what will be left behind? So it's going to be an interesting year to watch, as I think we're going to have another positive year, but a different theme where it's not rotating all sectors, but there will be some real big standouts.
Okay, staying with you, Jay, on this one. We're not gonna spend a ton of time on this, I promise, but we're gonna definitely discuss the Trump factor. Okay, we had an election last month. This would effectively represent Donald Trump's reelection, even though he took a 4-year break in the middle. Based on some of the things that maybe he campaigned on and some of the things that he's now talking about, what are some of the things you're expecting to see, or what will that mean to the markets and the economy?
Well, we're seeing it right out of the gate with crypto. I mean, he put out a tweet on his platform, True Social, "You're welcome," as crypto has basically doubled since his election. What we've seen in the crypto-related stocks, those ETFs that follow crypto, I think that story will continue and will be watched very closely. The financials, to me, were a Trump trade and will continue to be a strong theme. He has been somebody who's been against red tape, and we should see it happen. But the one thing that may surprise people, when you talk about the Trump trade, this is Trump 2.0. It could be very different. I think it will be, tariffs will be more effective right out of the gates than they were the first time. But 2017, his first year in office, we were up every month that year. The S&P 500 was just up over 19%. We didn't have one day where we had a drawdown of 2%. So volatile headlines, but not volatile markets. That's what we had the first time. Let's see if that can repeat. But the strength right now, we've seen it. And then once he's in office, we'll see where he goes next. But Jerome Powell is going to be there to the end of his term. I think that's good for the markets as well.
Okay. Christy, what do you see? Is there an ETF play here with a second Trump presidency, a second Trump term?
Yeah, and this was kind of picking up from that thread too from Jay. Like, we've also been sort of surprised by how much market reaction post-election has mimicked the response in 2016. And, I think it has. If you look at sort of the 1 month post for a lot of different sectors, maybe Bitcoin wasn't as big back then, but if you look at small caps, if you look at value, the trades that worked then have largely worked now. Well, we're in a really different economic backdrop as well, which makes us think that you don't necessarily see those trades specifically extending into 2025. So we've got interest rates are higher, we've got the deficit is higher. And in general, growth is strong, but it is slowing. So it's a little bit different of a macro backdrop that leads us to kind of different of sort of a micro play and how to put that into a portfolio. But really, when we look at the policy changes that are expected to come with the Trump presidency, I think you've got sort of the good and the bad for markets in terms of how investors are really digesting those, right? As you've got deregulation or the prospect of deregulation and tax cuts on the one side. And then you've got the prospect of tariffs and possibly curbed immigration on the other side. So we've got kind of a tightrope to walk here. And I think one of the most important themes that we see, for investors thinking about the 2025 portfolio is just being able to be dynamic, being able to be nimble. We've talked a lot about, we think the rise of active management within ETFs makes a lot of sense. DYNF, which is the BlackRock Dynamic Factor Rotation ETF. It is the largest active ETF we have. I think, that has had tremendous performance up till now. I think that's really going to be one to think about for 2025 as the market digests all of those policy changes, and you need to react sort of quickly, both kind of to the policy changes and to the macro environment that's going to move as a result.
Okay. Nick, have you been buying crypto along with the rest of the world since Trump was elected?
Yeah, I tell you, my world's a little bit on the factor side, so little personal,
Okay.
probably not relevant much to this conversation. But, I would say, when I look into 2025, really what you're seeing is this kind of idea that Trump's going to be, as my colleague said here, he's good for smaller stocks. He could be good for values, low regulation, good for growth, which really argues for smaller stocks and value stocks to do better. I would say, in addition to that, you're kind of facing an unusual market in that the S&P 500 is very high valuation premium. We haven't seen this kind of stretched valuation since basically the pandemic and the tech bubble. You see an S&P 500 index that is very, very growthy, overlap to the NASDAQ 100, almost 47%. And so really, I think investors are going to have to kind of navigate through that. And that really opens the door in my world to, the Invesco S&P 500 equal weight, RSP. That's an option. And if you're looking for things that are less expensive down the cap spectrum where they are, that opens the door to like a mid cap revenue weight or a small cap revenue weight ETF, so RWK, RWJ. Those would be kind of options to try to navigate the valuation. And I think play on this idea that the new administration will be friendlier for smaller stocks. And there was some confirmation of that today when you saw the small business confidence survey come out. And I think I read on the wire, it is like jumped for the most in 44 years, which tends to be fairly correlated or tied to kind of what goes on in the profit segment way down the cap spectrum.
Okay. We have a question here, and I'm going to get to it in 1 second because I want to encourage questions. So I can't encourage questions if I'm not going to ask them, right? All right. It says how to ride the Mag 7 exuberance. I don't know. There's a MAGS ETF. It says S&P overweight ? SPY excluding tech. Any thoughts on that?
Yeah, I can jump in there in terms of some of our views. I think what we've been talking about a bit right now is that this feels more like a time for us to move from the mega cap to the large cap, not necessarily all the way from large to small. I know that small has had a tremendous run up so far. We don't necessarily think that there's a ton more oxygen in that trade, and primarily we think that because we don't think interest rates are coming down as fast as the market previously thought. And so, we do see some room to maybe diversify away a little bit from the Magnificent Seven. We're still overweight the U.S. We're still overweight, growth relative to value. but being more deliberate about adding value into a portfolio, exactly the point that Nick was just making. If you look at the composition of the S&P 500 index right now, it skews much more to growth than it has in the past. So on the one hand, it's a little bit concerning that your whole portfolio might be growth. So we like adding something deliberate. The BlackRock Large Cap Value, BLCV, is a fund that we see a lot of opportunity in right now. It's actively managed, it's relatively concentrated, but it's specifically picking value funds. We think that can be a nice counterweight to just an S&P 500 exposure because it adds back in that value component that you're not getting in the benchmark index right now.
And Nick, you mentioned RSP. That's the equal weight S&P. Was there anything else you would add on that?
Well, I think if you're looking to kind of own what is driving the market or is showing the leadership, that my tendency there is to suggest momentum is a factor. So something like the Invesco S&P 500 Momentum ETF SPMO, that's going to essentially own the stocks that are showing leadership in the market. It's going to reconstitute twice a year. So it's going to pick up what's working. And if that fails, it's going to kick it out and kind of pick up the new leadership in the market. And I think that's a systematic, rules-based, unemotional way to kind of get growth, get the leadership that is present. I would say we just launched an Invesco, top NASDAQ QBIG, which picks up about the 47% of the NASDAQ 100. And so that's going to give you more of those big names that have shown a lot of R&D. They've shown a lot of fundamental earnings and sales growth because of their size. But again, like it has the ability every year to kind of reconstitute. So if a name falls out, it can be removed. So there's some dynamic aspect as opposed to just trying to ride the same 7 names. There's a way to go about it in maybe a more pointed way, which you can manage some of the risks that go along with what could be a crowded trade.
Well, what are your thoughts on, Jay? Is it still fun to just ride the Mag 7 all the way to the sky?
Well, it is always fun, and I think it's probably the safest place to be. But what we're seeing is a little more speculative nature to this rally, and stocks that are Mag 7 adjacent in the technology space do well. And you want to revisit, and this is from a technical point of view, as I am a technician, some of those Cathie Woods funds, ARC-W, the next generative technology ETF that she has started to take off. A lot of it is part of the Trump trade. It has a lot of crypto and a lot of AI names in there that are worth taking a look if you think that that is the next way to go. And then here's another one, the IPO, the Renaissance IPO ETF. A lot of those names that went public that had those high flying days when they first went public in 2021, at the end of that, early 2022, they're starting to come back and they're starting to really make some noise as people look for value. So those are adjacent, smaller ones that look to kind of emulate some of those Mag 7 names. But no, of course, I would rather be in the biggest names possible. And I love the QBIG that Nick was talking about. That's something I was just looking at recently. And I think that's a great way of playing the technology Mag 7 side without having the other 53 names that make up the QQQs.
Okay. We got a couple more questions here, but I want to go back to the sort of the outline here of looking at the unfolding 2025. The 4 things here, and they're all related, so I'm going to throw them all into one question: the Fed, inflation, recession threat, and interest rates. Jay, can you put that into some kind of a context for people? Is the Fed going to keep cutting rates? Is inflation not an issue right now? Is a recession the soft landing? Is it just it's not even talked about?
Yeah, I mean, this is a grenade you just threw at us with this question, but I'll try to summarize it. Right now, we're in that no landing scenario, and when you look at the Fed and you look at this Jerome Powell-led Fed, he doesn't mess around with his one data point at a time narrative. He does telegraph what's going to happen. I do not think we're on the verge of a recession. I know a lot of people think second half of this year it could happen, but right now we're in that no landing where the CPI, which we get data soon enough, has started to tick up slightly since they cut rates. Unemployment stabilized, actually ticked up a little bit as well. So a lot of raised eyebrows at the Fed where I don't think they're going to have to cut, but we can keep at this level and fly the plane without landing it here. We should be okay for the first 2 quarters going out, but it is going to be interesting to watch. And then we mentioned the president. He does like to get a little pushy when it comes to rates and putting his opinion out there. I don't think Jerome Powell will fall for it, but I got to take the Jerome Powell approach, one data point at a time, and I don't see any looming recession, but I don't see this soft landing happening quickly either.
Okay, Christy, your take on that? As Jay said, the grenade I threw at you.
Grenade, multifaceted grenade there. But yeah, so I'll kind of go one at a time. I think, from a recession perspective, that's not what we see in the cards, at least for now. I'll hedge myself there, as kind of Jay did, and I assume Jay Powell will as well. But that's not what we see in the cards. That's not what the data is showing us. So the economy still looks strong. As a result of that, there's not really a need for the Fed to cut interest rates as much as we thought even a couple months ago. So yes, you're going to see a cut from the Fed next week. We're going to get an updated dot plot of statement of economic projection. So we're going to get a little bit of a sense for where their head's at. And we'll see what next year looks like, but certainly less cuts than we were thinking a month or two ago, even because of the strength of the economy. That said, even though interest rates have come down a little bit and the Fed is cutting, that doesn't necessarily mean that longer term rates have come down. So I think that's a really important marker to watch, as longer term rates are not just going to encapsulate monetary policy, but fiscal policy as well. So when we look at the market and things that we're watching out for that could possibly knock us off of our view of being overweight equities, being overweight the U.S., still liking the growth and the momentum that we saw in 2024, I think the biggest risks are long-term interest rates move even higher. That's obviously hard for companies to manage who are investing in AI and R&D and long-term projects. And then the second is inflation. And that was kind of your last stool, leg of the stool there of what we're thinking about from a macro perspective. If inflation does start to creep higher and we do start to see it in the data, I think that would be a big warning sign for the equity market rally. We like being specific now about adding in a little bit of inflation protection, something like STIF, which is a short-term treasury and inflation protected bond ETF. A little bit can kind of go a long way there. We don't like taking a ton of duration, but we do like being really deliberate about inflation, because I think if we do start to see that tick higher, that's going to be a big warning sign for the equity market. So you're going to need to rely on the rest of your portfolio at that point.
Okay, what was you gave a ticker on you said STIF?
STIP. So just short
STIP.
treasury
STIP.
inflation protection.
Gotcha.
Yep, exactly.
All right, Nick, same question. I don't know why these guys acted like it was such a hard question. I think it's an easy question. I think they all go together, but you go ahead. Fed, inflation, recession.
So I think my view right now is that inflation's been sticky. I mean, the core CPI has been hovering in the low 3%. Things like Cleveland Fed median, services, ex energy, these things are a bit elevated. So I think that slows down the Fed quite a bit. And I think if you're a fan of the Taylor rule, for example, there's not a lot of room for the Fed to move here. Now, having said that, there's some wild cards out there. You've got how effective will the Trump administration be in terms of downsizing the government and eliminating waste? And will that be a deflationary type of shock? Likewise, with the lower deregulation, if that occurs, will that help to lower inflation? And so these things are really got to play themselves out. And I think the Fed is going to be somewhat reactionary, kind of watching how they play out, because they have cut rates down to an area where things are a bit less restrictive. I think, as we said, like the growth outlook still looks fairly constructive here. And I think one of the things that the equity market has for it is that the comps for earnings kind of outside the big names are fairly easy. And you do have this idea that maybe you're going to see the animal spirits unleashed, and that's going to help profit growth. And I think it fits in a bit to the story of smaller stocks kind of finally shining in the marketplace.
Okay, let's go into some sectors a little bit. What sectors, Nick, I'm going to stick with you here. What sectors look the most promising in the year ahead, and why? And I say the year ahead, I'm like, I don't care. You can tell me January, whatever. It's all next year.
Yeah, so this would probably go back into a little bit Jay said about financials, I think, are big. So I'm, suggesting to our clients we look at the S&P 500 equal weight financial ETF RSPF. There's a couple things there. I mean, not only gives deregulation, but you started to see some buds on M&A activity. The yield curve looks like it's on a steepening trend. That tends to be good for financials, especially banks. And I think the recession probabilities, like if you look at some of the Fed's data, looking at the yield curve, those recession probabilities have been falling. So that's all good, I think, for the financial story. And those certainly have kind of lagged in, over the last 10 years and really have not had a great run. The other area which I'm kind of fascinated with is actually utilities. And this is kind of a very strong story. So in my world, we have the S&P 500 equal weight utility ETF RSPU. And why do I like utilities? Well, what do we see? Onshoring, AI power needs, all the data crunching power needs, national security bringing things home. We have these chip plants being done. Somebody's got to power these things. And if you look at the percentage of manufacturing construction spending relative to the whole, it's been in a very strong uptrend. And these plants, they need power to produce. And so there's actually, I think, a growth story that is present there. And I think there's a pretty big runway for that to manifest itself to meet kind of what's going on in terms of technology.
Okay, Jay, what do you see in terms of sectors?
Well, Nick is stealing all my thunder there with the utilities. And I have a question for the panel. Am I allowed to ask questions? Do I have to?
Absolutely, you are.
I am looking for a utility-based ETF that does more on the nuclear side, because that has been a trend we're seeing. Is there an ETF that either of you offer that is focused in on that, or is that something to look forward to in the future? Because I believe nuclear power and the way they need to produce it has become, one, safer, and two, a demand that you see that who is it? The Oklos of the world creating their own plants, and Bill Gates putting money into nuclear. Is there something that Christy or Nick are seeing on the nuclear side?
We have nothing.
All right. Well, I gave everyone a project.
Put you in touch.
All right. Well,
put you in touch with our product innovation team.
Exactly. Okay. Let's get on that. But
Jay, let me jump in there real quick on that. While we were talking, you're asking your question. Yeah. I went to ETF.com and just typed in nuke, and there's 7 ETFs that focus on nuclear energy. If anybody wants to look those up, it's a pretty short list. 7 ETFs. Just type in nuke. You'll find what you're looking for.
Researching that later.
Okay.
But to give you something different, the cybersecurity theme continues to be a strong theme that we're going to see, we're going to need. And I look at the 2 cyber ETFs, the Hack, the Amplify Cybersecurity ETF, and Cyber CIBR, which is the first trust cybersecurity ETF. Both of these have been strong. It took them a little while to see them take off, but both have broken out. The stocks that are the makeup, the top 10 stocks, to me look fantastic from a technical point of view. When you look at a Palo Alto, that to me is probably the shining star of the group. These are where strength will always be needed, and I see a strong demand. So those are the 2 ETFs that I like. And then I think biotech, from a small cap point of view, the IBB, which is the iShares Biotechnology ETF, that has been stagnant for a long time. One thing Trump did when he came to office the first time is he cut a lot of red tape trying to get these drugs to pass. And the IBB was up 40% his first year in office. Let's see if history can repeat itself. Right now, it's been lagging, but it has a nice base. If it can break out, it could have a nice tailwind behind it.
Okay, Christy, I think he's throwing you softballs there with the IBB thing, yeah. But you guys working together here. But anyway, so talk to me a little bit about the sectors that you see most promising. And also, I'm going to let you know the next round of questions is going to be the sectors that represent areas of risk. So you're going to get the 1-2 punch, Christy, and then we're going to go around the horn. All right.
Okay, sounds good. So, in terms of opportunities, I'll also echo some of the opportunities in financials. IYF is our product, the iShares Financials ETF. that's something that we have been having a lot of conversations with investors about. I think that the tailwinds there include not only sort of the prospect of deregulation, a steepening yield curve, which is generally good for financials, can improve their net interest margins, and an uptick in M&A activity. And then just another one that I think is maybe a little less, a less specific, but still maybe helpful, is that just, being in the services category rather than the goods category can be helpful if tariffs are being applied. So being able to sort of sidestep the tariffs and being a little bit more America first in that trade. So financials do, they perform really well, I think, which is the thing that we've spent some time looking at. Is we've seen a lot of strong performance already, but we do think that there is more runway for next year, particularly kind of powered by that M&A activity. So whether that's broad financials, we also have an ETF that focuses just on sort of broker dealers and exchanges, if you really want to play the M&A side of that, which I think is helpful. And then yeah, I think that the other opportunities are sort of in the where is the AI trade going next category, right? And so we saw that affect hardware in the form of semiconductors. Since about earlier this year, we saw that start to spread out, as we talked about, to utilities, to data centers. I think we're still kind of in the picks and shovels, stage of the AI build out, where it's the requirements to actually create the compute that's needed to be able to do it. But we're actually starting to see a rotation right now of the AI trade, even within the technology sector. So we're seeing it moving from hardware into software. And that's more of some of the software companies that are actually able to benefit from AI and use AI to enhance their customer service experience. So I think that there's lots of ways to invest in this. ARTY is our index ETF that tracks kind of the AI trade. And then BAI, BlackRock AI ETF, is newly launched. That's from our investor, Tony Kim. And that really allows you to go kind of the full stack of AI types of investments, hardware and software, picks and shovels and beneficiaries. It can move a lot more quickly, too, than sometimes the indexes can. So I think the AI trade alive and well, but what the AI trade is and what it looks like is changing. And that's probably going to continue to change into 2025, too. So not specifically a sector bet, almost more of a thematic. But yeah, still see opportunities in those areas.
Okay, now the areas of risk in the sector space. And this is where I expect you're not going to be naming so many of your own ETFs.
How'd you guess? No. So, I think energy broadly, notwithstanding some of the pockets of opportunity for how it's powering AI, can be challenged because of the slow growth that we're seeing out of China. And if the world is really, there's a dual growth engine of the world, and it is the US and it is China. And when China growth is slowed and stalling, it can be really hard for commodities to perform as well as they would be if global growth was accelerating. And so I think thinking about the world along the lines of, the playbook that worked in the past may not be as applicable because of the China slowdown. So energy broadly, I would be a little bit cautious with from that perspective. But that also brings up a question of how do you hedge inflation without your traditional commodity plays if we think inflation's going to pick up? So there's lots of conversations to go there. I'd be a little bit concerned about energy. And then, this is an opportunity, not necessarily one where we see the strongest earnings growth, but we do kind of like aerospace and defense just as a hedge against some of the geopolitical risks. So not liking the sector just for the sector's sake in terms of earnings growth, but we do like it just for its sensitivity to tariffs and trade policy uncertainty.
Okay, Jay, sectors that you're not in love with.
Well, if Robert Kennedy does get confirmed, I think the giant healthcare stocks, the XLV, that is one you're going to have to avoid for the next year or so.
Okay.
We've seen downward pressure since his nomination, and that is something to keep an eye on because he's going to take those traditional companies and turn them upside down. And I hate to pick on Nick, the Invesco solar ETF TAN has been under some pressure, and it probably will be under pressure for the next year or so. I don't believe this is a story that's going to go away when you talk about alternative energy, but at least in the first part of the Trump regime, it probably will. And then what you'll see is energy start to lag in the second half as he is in office, because gas prices are what drives this economy. And if gas prices run up, then watch out for some weakness in the energy sector. But right now, I would go stay away from solar still and watch out those healthcare stocks. Biotech, I did like, but the bigger healthcare could be under some pressure. And then watch real estate, the XLRE. I'm using Spider Select ETFs, the bigger ones. That could be under pressure with Doge. When they cut government jobs, a lot of that cut will also be real estate investments that they have. The government owns a lot of real estate,
Mhm.
and it'll be interesting to see what effects that has on some of these big real estate companies and the sector itself as well.
Nick, what are there sectors that you would maybe avoid in the year ahead based on even some of the things that Christy and Jay said?
Yeah, I mean, I think Christy and Jay touched on some of the majors. I mean, I myself see a great amount of uncertainty when it comes to like traditional energy, just because Trump's deregulating or expected to deregulate. We want to increase production. That's not necessarily going to be helpful to price. And then you overlay that kind of what's going on, like what's going to happen in the Middle East, what's going to happen with Iranian oil. Is it going to be offline? Are they going to like topple? Like, was there going to be more change like we saw in Syria? And then on top of that, the Strategic Petroleum Reserve is pretty depleted. So there's too many cross currents in there for me to have a high level of really certainty. And likewise, when I think a little bit about materials, that China question is something that kind of hangs a little bit over the market. And I think there might be stronger ways to kind of play, the growth and using industrials, for example, as a way to deal with the onshoring, reshoring, and what the vibrant growth is.
Okay. I see your questions, folks, and we're going to get to as many as we can. There was a question here, though. Can we list all the ETFs that have been recommended? I don't know if that's going to be possible, but I will tell you that by tomorrow, there's going to be a replay of this webinar available. So I guess you could listen to it again and screen for the ETFs listed. I do want to read a question here. Do you see other policy choices from the incoming administration? I guess example, immigration impacting the low end of employment like agriculture and commodities. Any comments on that at all from anyone? No?
No, I'd like to avoid those questions personally
Okay.
if I was on air. That is a fair question, good question, but I really don't have an educated guess as to what deeper impact it will have. But that is something that is a concern when you get rid of a lot of these low-paying wage jobs. It could have an impact on some of these, agricultural stocks and even some of the restaurant stocks and travel and leisure stocks.
Okay. This is something that Nick, you and I had talked about in an earlier conversation. I think this is you I was talking about portfolio management and concentration risk.
Mm-hmm.
We've been talking about it for the first 30 minutes or so of this conversation, all of us, about the Mag 7. We're talking a little bit about equal weighting, talking about diversifying away from the things that have been carrying things for the past couple of years. Nick, can you go into that a little bit about what concentration risk could mean for investors?
Yeah, so it's quite interesting right now. I say the first thing that comes to my mind is if you look at the cap-weighted S&P 500, the contribution to risk from those top 10 names is historically high. So about 55%, the last calculation we did of this, of the standard deviation, is linked to those big names. And it's because they have a lot of volatility, they have a big weight, and they all move together. So we're in a situation here where if you look at the 30-day historical volatility, it's actually higher for the S&P 500 than it is for RSP, or the equal weighted S&P 500. Very unusual. In fact, if you do a factor analysis, you'll actually see RSP tilting towards low volatility because of that. So I think investors not only have this risk of putting a few eggs in their basket, like there's too much risk there, because we know that over time leadership changes. Like, you look back 10 years, 20 years, 30 years, those names change. And you've seen it, somewhat recently, where all of a sudden you see Amazon has a new chip, or Alphabet has a new chip. Like, what does that mean for NVIDIA? So there's always this kind of disruption. And I think that investors need to be aware of that. Also, it's caused the S&P to become more growthy. So this has really been something that's been great for RSP equal weight, because what we're seeing is clients try to manage that through equal weight. And we're actually seeing strong demand, despite the fact that really the performance has been, on the doggy side here, if you look over the last couple years. I would say, in addition to that, what you tend to see is when concentration goes down, that tends to be very good for small size value and kind of the broader market. And so, that's one thing that you should think about. And you should also know that concentration mean reverts. So over time, we're up near records here at 37% was the peak in June. You have to go back to the 1970s to get that type of number, but it got down to around 14.5%, a couple 10 years, 20 years back. So it does fluctuate. And I think if concentration starts to normalize or mean revert, it's going to be good for, more traditional factor investing.
Christy, what are your thoughts on concentration risk?
Yeah, we've got a lot of investors who speak like who are concerned about this, but I think that more than ever, there are new tools to be able to safeguard your portfolio against this. And I'll give you an example. If we look at kind of, the concentration risk within equities right now, and fixed income, we're a little bit hesitant on the long end of the curve. So we don't love duration as a hedge as much as it used to be. But for investors who are concerned with how much of their portfolio is driven by just a handful of names and the earnings growth of NVIDIA, for example, we do offer things, and we've had a lot more closing conversation around things like buffered ETFs. So rather than needing to tilt into low volatility and really miss a lot of the upside that you got this year, for example, there's been a cost to being under risk in your portfolio, whether we're talking about fixed income or stocks. And so we don't necessarily like leaning into low volatility in this market. I'd call us and characterize us more pro risk or risk on, but adding a little bit of like a buffered ETF, which uses options to explicitly protect against the downside, can be a way to mimic more of a 60-40 type of portfolio return while letting yourself still participate in the growth at the top end of the market. So you don't necessarily have to call where the risk is going to come from. But you can kind of, you can use options to hedge out some of the deeper downside that you could see if that momentum in the top part of the market turns.
All right. I wasn't going to talk about buffered strategies. It wasn't on the list. And not that I'm against it. It's a perfect topic for this time. I'm serious. It's I don't know how we didn't think about that in our prep call. But since you brought it up, Christy, explain to our audience, for those who might not be familiar, what this is, but what the buffers are. How that works. Yeah, exactly. So you're trading options, basically. So what you're doing is you're giving up a little bit of upside by selling an option and using the proceeds from that to buy a put option, so you can explicitly protect your downside. So there's lots of mechanics and nuances to the price that you get in and what exactly the upside potential is and the downside protection is, which I would send people to our website to look at it on any given day. But that's kind of the gist of it, right? Is you trade away a little upside potential and you lock in some downside protection. Yeah, but the problem was, I think, with my question, I really were just telling people that a buffer has an upside cap. You can only you're limited on how much you can gain, and in exchange for that, or basically you've got a downside protection. You can only lose so much. You can only go down so much. In exchange for that, you have a cap on how much you can gain. Now, these have become really popular, right?
Yeah, and I think of these as just being a new, more modern portfolio construction tool that sits within an ETF wrapper. So it's familiar, you can trade it. You can access it in the same place you would trade any other ETF. But what it does is build in downside protection. And that's not necessarily something that you're getting from the bond side of your portfolio. When we see, where we're not duration hasn't been a reliable hedge. We've seen stock bond correlation flip-flop between positive and negative more in the last 5 years than we have in the last 20. So if you don't have that reliable, buffer, hedge within your portfolio, you got to think outside of it. And I think buffered ETFs are a really interesting tool that investors are using to hedge away, and not just concentration risk, but earnings slowdown, growth slowdown, economic slowdown as well.
Jay, what are your thoughts on buffer strategies? To me, I look at them as a way for, I think, financial advisors to keep their clients exposed to the equity markets when they might be getting a little bit nervous. But is the trade-off worth it?
Well, to me, first of all, I was just taking notes. So Christy was dropping a lot of great knowledge there. I'll watch the playback and finish that. But listen, in any investing strategy, you want to have some sort of hedge in place, something that you can go back to your clients and say, okay, well, if this happens, then we're protected there. So the buffer strategy, to me, to be honest, is new as someone that follows ETFs from more of a distance and not deals with them every day like Nick and Christy. So to me, I would punt this question to Nick because I really want to hear his answer.
Yeah, so I'm going to play a little devil's advocate here, because I think one of the risks to the buffer strategies that are based on, let's say, the S&P 500 plays right into the concentration story. Like, the question to me is, like, what happens if you go into like a 1999 to 2010 scenario where the cap weighted market basically spins its wheels? You will get little upside. You may not get, you'll get that protection, but you have no upside. And other factors such as low volatility or value can actually generate some positive return out there. So I think you have to be kind of cognizant of the fact that when you're doing a buffer, like, what's your index, what's the risk to that index, and how is that going to impact your payoff, especially on the upside. So like, if I look at my SPLV, now this is my baby, and I'm talking my book and I'm talking Invesco's book, I mean, it's up just short of 18% this year. So it's never gonna match in an up market, but it wins by playing defense, meaning that when the market sells off, historically it doesn't sell off as much, and thus it has less to make up for going forward. And then you're also exploiting the low volatility anomaly. So I just throw that out there as something to think about. I would not have as strong of an argument to make maybe if we were talking about doing something on, the mid cap or the small cap indexes, which don't have that concentration problem.
Okay, let me go to a question here. It's about valuations. I'm going to read it. There's been a lot of noise about PE ratios of companies and the market, and that the market is overbought. Do you think the market is overbought, or is the PE ratio, or are the PE ratios justified? Jay?
Oh, thank you for coming to me first on this one. I just actually had a conversation about this at lunch. I put things back in historical perspective, and we've already talked about how this resembles the 90s. And when you look back on time, PE ratios will fluctuate, and there are times where in a stagnant market, this is an accelerated PE, especially on some of these Mag 7 names, but historically, they're not. We don't have things trading at ridiculous multiples right now as far as the big S&P 500 companies out there. Yes, they're elevated. Yes, it's slightly concerning, but we are seeing continued earnings growth. We are not in a euphoric time period yet. We're not in a bubble yet. It is slowly starting to inflate, but when you put it in historical perspective, the PE ratios are okay being elevated at these levels, and I don't think there's a panic that it's getting a little too far out above our skis at this point in time.
Okay, Christy.
Yeah, I preempted you. Sorry about that. But yeah, I'll jump into, and it's something that we touched on already. But if you look at the composition of the S&P 500, it is just much more, it is much more skewed to growth stocks than it is value. In the past, that used to be much more even. I talked about that as a moment to deliberately add to value, but it also has a really important implication for valuations too, because growth stocks always trade at a higher multiple than value stocks do. And so the S&P being at a higher multiple in part just reflects that it has a different constituency than it did in the past. So we're not overly concerned about valuations. Valuations are also not a great tactical, timing model of when to trade in and out of things. Yes, they can flash warning signs if they're too high or they're stretched. But I think it's really important that the performance that we've seen so far this year was in part driven by multiple expansion, but it was also just really powered by earnings growth. So if you look at NVIDIA, multiples for that and the valuations for that have come down over time because the earnings have more than grown into or justified some of the valuation. So we're not at the point where we're panicking yet. It is certainly something to watch. And I think there's opportunities at lower valuations that you can get into for the long term, but it's not a hit the panic button for right now moment either.
Okay. Nick, I'm imagining you're chomping at the bit for this question, but we got a few more things to get to, and I want to get to them because they're we haven't even talked about fixed income yet, really. Real quickly, fixed income. Where does fixed income fit in this market, and does anybody even care that the yield curve is inverted anymore, Nick?
Well, I mean, I would say, first of all, from my vantage point, I, as an equity person, and I think empirically this will play out in recent years, owning a dividend yielding strategy, like in our case, the S&P 500 high dividend, low volatility ETF, has really beaten some of the broader benchmarks like the ag or corporate. And so on a risk adjusted basis, certainly dividend stocks are more volatile, but you've got a stronger total return, a very competitive yield, and you have the possibility of the distribution growing over time, actually protecting you against inflation, as opposed to a fixed coupon, which is not adjusted and is being kind of eroded. So my answer to you is to really seriously think about kind of dividend strategies as part of your fixed income solution, because I think when you start blending them into more traditional fixed income solutions, you're going to see that they can add a lot of value, especially if you can look at them on a risk adjusted basis or handle some of the short term volatility that's present in equity over debt.
Okay, Christy, does BlackRock also feel like dividend strategies are the answer to fixed income? And I apologize if that sounds like I put words in your mouth, Nick, but I'm trying to be a little bit sensational here.
We'll allow it. I think dividends have a really important place to serve, especially in a portfolio that is specifically looking for income. I think that it tilts a little bit more value, but also screens for quality. So yes, we do like dividend stocks and see an opportunity there, but we also don't dislike fixed income. I've talked a lot about how we don't like the long end of the yield curve, and the duration trade may be less than what it was before, but there are still phenomenal opportunities within fixed income markets, higher yields on offer than we've seen in most of the last 20, 30 years. So we do think this is a golden age for fixed income. It's maybe not, super long duration, but, for example, we really like high yield right now, where we think economic risk is pretty low and yields are really high. And that's a good combination. There's opportunities in securitized, there's opportunities in emerging markets. Maybe this isn't sort of the standard investment grade US corporate fixed income moment, but we do think that this is a fixed income moment. And I think it's going to be more about income than duration in 2025. BINC, which is the BlackRock Income ETF, so pretty easy to remember, is probably the best reflection of our views for where we see opportunity in fixed income. It's actively managed. It can go anywhere. It can take advantage of those higher yields while still managing risk and duration. And that's something that, we think has a place in many portfolios, because again, you can't hold just equities that's taking on a lot of risk there. We need some ballast, and I think it's going to come from the income side of fixed income more than it's going to come from duration.
Okay, we got to go lightning round here now. Cryptocurrencies, okay? They were introduced at 2024, January 2024. We got Bitcoin ETFs. I think it was July, we got Ethereum ETFs. Did that change the game in the crypto space? Financial advisors, we know, are still generally on the sidelines. I wrote a story about this last week, and I couldn't believe the feedback I got from advisors emailing me, telling me they were not saying like I was a smart person. So I'm wondering, how much did Bitcoin or crypto ETFs change kind of the ETF landscape? Christy, we'll start with you there.
Yeah, I mean, I think that like most advancements, it is a new tool and it is a technology for investors to use. Moving it into the ETF made it accessible. So I think it's about market access. IBIT, which is our BlackRock Bitcoin ETF, which is the largest one, just crossed $50 billion in AUM. It launched in January. So that is the fastest growing, by all accounts, most successful ETF launch of all time. I think, one of the things that we've been watching and tracking, and this sounds a little specific, the trade sizes. So whereas in the beginning, in the first kind of 4 or 5 months since this product launched, the trade sizes were really small, call it $4,000 at a time. That told us there were lots of retail investors, lots of individual investors. What we've seen more recently is those trade sizes have moved up and up. So we're seeing more institutional, more professional investors allocate to Bitcoin and to cryptocurrencies more broadly. And I think it's just a differentiated source of risk and return. So a little bit can go a long way, but we're definitely seeing adoption from the more sophisticated investor types as well, which is not something you could have said in kind of January or February. So I think that will continue.
Jay, what do you see on the crypto front, specifically crypto ETFs?
Yeah, I think it's a safe way to invest first and foremost. The demand for it is ridiculously strong. It's such a buzzword right now. So when you talk to financial planners and financial advisors, their clients want to talk about crypto. They want to learn about it. And I think the best way of learning is by doing. So we know it's been legitimized. We know it's an asset class here to stay. So people need exposure to it. And the best way is through some of these ETFs. I'm not going to name names to promote one versus the other. There are several out there. But no, crypto is getting more and more legitimacy. But what I fear is it's becoming a little too euphoric. I don't think it's over by any stretch of the imagination. Technically, Bitcoin could go to 135 in a matter of months once we get a new SEC commissioner in there. But it is a little too high risk, high reward, where I would kind of pump the brakes on it when talking to individual investors. But I like Christie's data saying that it's not just the small retail investors anymore. So it is here to stay. And it's going to be interesting to see how it shakes out under this new administration.
Okay, Nick, your thoughts on crypto, then we're going to wrap up with predictions.
Okay, I'll shamelessly say we have BTCO, we have Galaxy as a partner for our Bitcoin offering. But I'd say, the ETF wrapper has been very constructive for Bitcoin. I think the fact you can put in a brokerage account, can buy and sell it very, very easily. People are very comfortable with the ETF wrapper. I think it's really opened it up, not only for the retail investor, but I think for institutions. I'll leave it at that.
Okay, and sticking with you, got a prediction or two for us for 2025?
I'd like to predict a winning Chicago sports team, but that's not possible. So I'll tell you two things. I think early in the year, low volatility actually has a nice move because I think as we go into early year, you're going to see some profit taking. You're going to see some recalibration on valuation. But I think when the dust settles at the end of the year, you're going to be happy owning small and big cap stocks. So that's kind of my two ideas, short term.
Okay. All right. Thank you. Jay, I know you're a Philadelphia Eagles fan. So
how'd you know I was going there right away? Yeah, go Birds. And yes, I predict the Philadelphia Eagles Super Bowl. Last time they got to the Super Bowl and won was 2018, and the market corrected pretty precipitously afterwards. We could see a small repeat on that. We have not had a big drawdown in quite some time. But that being said, I still think we are in a secular bull market. We're going to see rotation into this market. Technology will still lead, but it's going to be more of a stock picking market than we've ever seen before. And that is cliche. I hate saying it. I feel dirty saying that. And I believe to Nick's point and something I touched on earlier, utilities are going to be the fad, if you will. These are not your grandparents' utilities anymore. This is not a dividend yielding sector. And I think the strength will continue as people look for an alternative. And I believe it will be in utilities.
And Christy.
I think 2025 is going to be a year of inflection points and lots of rotations happening under the hood. So I'm going to call it that I think it's going to be the year of active, particularly on the equity side of the book. So we've seen a huge amount of flows start to gravitate there. I think that accelerates I think the performance justifies it too. And then I'm not much of a sports person outside of soccer, and next year is not a World Cup year. So I will say, I'll make my other one go back to our previous conversation about Bitcoin, and I will say IBIT will cross $75 billion next year, which is a pretty
75 billion.
Statement. Both, yeah, I think probably from flows as much as from price appreciation, but I think that's going to get set to grow.
Okay, since it's our last webinar of the year at ETF.com, I'm going to tell you that the Detroit Lions are going to win the Super Bowl. Sorry, Jay. They're going to score 38 points and win the Super Bowl. I want to thank everyone for joining. An on-demand version of this webinar will be sent out tomorrow. Everyone who attended will get a special discount offer to subscribe to ETF.com. So I want to thank you all for listening. Thank you for the great questions and comments. And Christy Akulian, BlackRock, Jay Woods, Freedom Capital Markets, and Nick Kalivas of Invesco. Thank you all.